there's a note that we've just recently published on Telstra. What it's really about is drawing your attention to an upcoming capital management framework, as they call it. Really, we think this is a will they or won't they cut the dividend review, and it's also going to come with the possibility of things like securitising or selling off those NBN payments and potentially using that capital for buybacks. So there's a lot of options there, but the most relevant one I really think is around the dividend. We'll know what they're going to do within the next 5 months, so before November of this year, but it seems most likely to happen around August. Telstra haven't been clear on the timing as yet. Look, just to be clear, we do not expect Telstra to cut their dividend. We're just drawing this to your attention as it is a risk that people should be aware could happen. And the crux of this decision is really whether or not you believe the NBN is going to succeed based on its current sort of financial perimeters. So if you believe the NBN is going to succeed, then there's something like a $1 billion hole in Telstra's EBITDA. You're not going to see that for the next 5 years because there's a bunch of one-off payments. But once those one-off payments stop, you could see Telstra's earnings drop to around 25 cents, or should I say its dividend around 25 cents if you believe the NBN continues in its form. If you don't, if you take my view, which is that the NBN's not going to succeed in its form, then I don't think you're going to see a hole in Telstra's earnings or its dividend. We've done a fair bit of work trying to support that view, and I can refer you to that note we published in April looking at the NBN economics if you want the more detailed view of that. I might also refer you to Google Fibre just for a bit of third-party validation. So if you look at Google, they stopped rolling out fibre to the last mile a while ago, and they've started using a combination of fibre and wireless, particularly wireless for the last mile. Google obviously is one of the 5 largest companies in the world, sitting on more than $100 billion US of cash, $100 billion of net cash, and they can't financially justify rolling fibre or an equivalent to the NBN around America. What they're doing is using a combination of fibre and wireless, and I think that really gives you some insight into where the world's going. It's not one or the other, it's both of them. So our view is that the NBN essentially won't have as many paying customers as they're expecting, and that's because there are better value alternatives elsewhere. For example, the Google Fibre thing I just talked about. But if you look locally, you can see Spirit Telecom using fixed wireless for the last mile. You can see companies like Superloop or Big Air using fixed wireless for the last mile. All of those still click back into fibre, but the reality is there's some better value alternatives than the NBN. And another one of those is actually mobile networks over time, starting to overlap there. So we think there's better value alternatives, which mean the NBN is unlikely to be as successful as they think, and therefore the hole not as big. For the next 5 years, you're going to see NBN one-off payments for Telstra expand from about 10% of EBITDA in the first half of 17 to more like 25%. And then that's going to drop off once the NBN rollout has completed. So they're going to basically mask the underlying trends in the earnings, but you just need to be aware what's happening there. So this capital management review is going to come out soon. Obviously, we'll get some insight as to how the board sees things going in the long term. We'll get a lot more detail then, but just needed to draw your attention to it. Just to close, we don't believe there is a risk to the dividend, but it is something you need to be aware of, and this capital management review is likely when you'll hear what the board thinks. Thank you.